Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Capital Power stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Capital Power is an independent power generation company. Independent companies own and operate facilities to generate electricity to sell on the open market. These type of companies are not public utilities like a PG&E is. This company develops, acquires, owns, and operates power generation facilities using a variety of energy sources. It owns 6,600 megawatts of power generation capacity at 26 facilities across North America, but a bulk of it is in Canada. 21% of its capacity is from renewable energy. This year, the company plans to develop 29 solar, 6 wind, and 11 storage facilities. The company is headquartered in Edmonton, Alberta, Canada, and was founded in 1891. The ticker trades on the TSX, OTC, and Deutsche Börse. Let's get started with the model. We're going to look at the ticker that trades on the TSX. So all the numbers in this video are in Canadian dollars. They're a mid-cap company, 4.8 billion market cap. They're trading at $41 a share, and they have 116 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year. It was high in 2020 at over 300 million, and it's currently at 245 million. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that seems to be declining from 267 million to 87 million. Revenue is the sales for the company, and that jumped up a lot from 2018 to 2019. Then it's been pretty flat after that. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that is down from 2020 from 1.2 billion to 1.1 billion. Below that is their operating expenses. Depreciation is a big operating expense for this company. Gross profit minus operating expenses gives you your operating income, and that is positive every year. It was high in 2019, and it's 338 million in 2021. Below that is the interest they pay in their debt, which is 140 million, a little lower than 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. If it's a big negative, it's probably an asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is positive every year, but declining. This is the company's income statement directly from their annual report. Their revenue was 1.8 billion in 2021. The way they generate revenue is through contracts by selling their electricity in the open market to different companies. 1.7 billion is from Alberta Commercial, 100 million from Western Canada, 300 million from Ontario, and 200 million in the US. They spent 667 million in purchasing energy and fuel, so their gross profit is 1.3 billion. They have really high gross margins, 75%. That's gross profit over revenue. The average in the industry is 36%. Their net margins are small, only 5%, but the average is negative in their industry. They spent 150 million in purchasing raw materials, 180 million on their staff, 539 million in depreciation and amortization, 58 million of impairments. So their operating income is 276 million. They spent 174 million of interest on their debt, so they do have positive net income of 87 million. Let's look at the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they generated the most cash flow in 2021, 867 million. A lot better than 2020, and they had a similar amount of revenue in 2021 compared to 2020. This company has to spend a lot on CapEx because they own and have to construct their facilities, and that's really expensive. They spent over 600 million in 2021. Operating cash flow minus CapEx gives you your free cash flow. And the reason people invest in companies like this is for the dividend. And they do pay a dividend every single quarter, and they've been paying it for many, many years. That's where the dividend comes from, the free cash flow. Since they pay a good dividend and they have to build out lots of infrastructure, they need to add debt most years to grow their business. They did add debt in 2018, $500 million, $300 million in 2019, only about $130 million in 2020. They did pay down $100 million of debt in 2021. They also add capital stock, $300 million in 2019 and $288 million in 2021. This is their operating cash flow section. And the way you calculate operating cash flow, you start with your net income, then you have to adjust for the non-cash items on the income statement and also adjust for changes in working capital. And that gives you your cash flow for the year. Even though they had an accounting profit of $87 million, they actually generated over $800 million of cash flow. That's mainly due to all the non-cash items on the income statement, depreciation and amortization over $500 million, and a bunch of other items as well. My two favorite numbers to track are revenue and operating cash flow. And you can see their revenue in the blue line looks good. It's increasing over time. Same thing with their operating cash flow. Both look strong and healthy. Their revenue is projected to grow a little bit from now through 2025. And the forecast for their operating cash flow is to remain pretty steady. This is their investing and financing sections from their statement of cash flows. In their investing section, they spent over $600 million in PP&E. They also received a $50 million grant from the government. When you work in an industry that's so vital, sometimes you receive tax breaks or government grants. So in their investing section, they had a cash outflow of $565 million. In their financing section, they received $236 million of debt. They paid down $340 million of debt. They issued $288 million of common stock. They paid down $200 million of preferred stock. They paid out $219 million of dividends and some other smaller items. So they had a cash outflow of $275 million in their financing section. This is the equity section on their 12/31 balance sheet. They have $2.8 billion of equity. They raised $3.6 billion from selling common stock, and they lost $671 million from running their business. Although they do have an accumulated deficit, but they are cash flow positive. The reason they have an accumulated deficit is because they pass through lots of large depreciation expenses in the early years. Let's look at the capital structure. $2.8 billion of equity, $3.5 billion of debt. They're 45% equity, 55% debt. Their equity balance was higher than their debt balance in 2015. Then it looks like that changed in 2019. The debt was higher, then they crossed again, but currently their debt is a little higher than their equity, and they do keep a small amount of cash on their balance sheet. But this is normal for companies like this. They do need to take on a lot of debt because they have to build out the infrastructure. And since they pay out a lot of their free cash flow and dividends, there's not much cash left over to grow the business. I gave them a whack of 6%. I thought 5% was a little too low, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $4.9 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $4.6 billion. We divide that by 116 million shares, and we get a calculated stock price of $40. They're trading at $41, so they're trading at a 3% premium. It's a sell according to the model. Their revenue is projected to grow 2.6%, so I grew their revenue 2.6% for the next 4 years. That's how I got their future revenue estimates. They convert 11% of their revenue into free cash flow, so I multiplied their future revenue estimates by 11%. That's how I got their future free cash flows. So it does appear they're trading pretty close to intrinsic value. The website Simply Wall Street values the company at 180. They're saying it's 77% undervalued. This is where the stock has been trading the last 5 years. And the price fell off a cliff during COVID. It fell below $25, but it almost doubled since that point. It has been regressing a little the past couple of months, but most stocks have been. It looks like it's coming back up from the bottom, but if you could have got it down here somewhere, your dividend yield would have been through the roof. In the past 5 years, the S&P 500 is up 79%. This stock is up 61%. They pretty much track each other the past 5 years. Once COVID hit, they both increased, but the S&P increased at a little faster rate. Prior to COVID, they were tracking each other almost identical. The company's projecting an 18% CAGR in its renewable sector, and they break it down by location on this chart. I know that's a really hot trend, renewables. They're actively spending CapEx to grow that part of the business. They raise their dividend each year. They pay 55 cents a share, and their dividend yield is really nice at 5.3%. It is over 100% of their free cash flow. But you want to look at this number over time. Over a long time frame, it can't be over 100%, or they wouldn't be in business. But it is possible in 1 year or 2 years, it's over 100%. But then if you look at other years, it'll be maybe 60%, 70%. And this is the 8th consecutive year they raised their dividend. And their guidance is to continue raising their dividend through 2025. Even in 2019, they were paying a 4.9% dividend. And they've always given back a pretty generous amount to their investors. It looks like the forecast is for their dividend to grow to 5% by the end of 2024. Their next dividend is on 4/29. If you purchase the stock on 3/29 this month or before, you will get the 4/29 dividend. But if you purchase the stock on 3/30 or after, you will not get this dividend. They have a low beta, 0.7, so the stock moves less than the market. It's gone up 13% in the past 52 weeks, while the S&P is up 7%. The 52-week low is 36, the high is 45. The stock is on an uptrend, trading above its 50-day and 200-day moving average. Only about 400,000 shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 20% are held by institutions and less than 1% of the shares are shorted. Their employee count has been pretty steady since 2019. They employ almost 800 people. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $25,000 today. That's 145% return. In the past 12 months, there's been 2 insider buys and 1 sell. 82% of the company is held by the general public, 18% by institutions, and 0.3% by insiders. Vanguard is the biggest shareholder at 3.25%. They have 3.8 million shares valued at 153 million Canadian dollars. Then BMO, also known as Bank of Montreal, they own 2.5%. BlackRock, TD Asset, and last is Dimensional Fund. Let's look at their financial ratios. Their PE is on the higher side at 55. That's stock price over earnings per share. Their price to sales is below the market average and median at 2.7. That's stock price over sales per share. And their price to book is good as well at 1.7. That's stock price over book value per share. Let's look at their non-current assets. $222 million in derivatives, $349 million from government grants, $145 million of investments in other companies, $120 million of right-of-use assets. This means they lease an asset that's owned by another company, $784 million of intangibles and goodwill, and $6.2 billion of property, plant, and equipment. Let's look at their non-current liabilities. $350 million of derivatives, $3.2 billion of debt. They owe $137 million on that right-of-use asset. $294 million of deferred revenue. This is when a company prepays for a product or service they're going to receive in the future. $600 million of deferred tax liabilities. This should increase their taxes in the future. And $400 million of provisions. Provisions are when a company puts cash aside for future potential losses. Their return on invested capital is 4.5%. They can cover the interest on their debt 2.5 times. They have a low ROE at 3%. Their current ratio is almost 1. Their quick ratio is 0.8. Quick ratio is current assets minus inventory over current liabilities. Let's look at their current assets. $400 million of cash, $500 million of receivables. This is how much money is owed to them. $200 million of inventory and $100 million of derivatives. Let's look at their current liabilities. $600 million of payables. This is how much money they owe others. And they have derivatives of $250 million. Commodity prices can be volatile, especially in the short term. So a company may use derivatives to smooth things out. So sometimes they buy futures, forwards, options, and swaps. They have $126 million in loans. If it's in the current liabilities, that means it's due within 12 months. If it's in non-current liabilities, that means it's due after 12 months. $150 million deferred revenue and $50 million of provisions. They generated $245 million of free cash flow in 2021. They have negative $19 million of working capital, and they pay out $254 million of dividend payments. So it looks like they're going to be short, so they may need to add some debt over the next 12 months to fund their operations. The best way to look at ratios to compare them to companies in the same industry. There are 5 companies in the same industry as CPX. They rank 4th in market cap. I converted all their market caps to Canadian dollars. The other companies are US companies. They have the best debt to equity ratio, so you can see how leveraged companies in this industry are. They pay the highest dividend. Their price to book is a little worse than average. Their PE is a lot worse than average. Their price to free cash flow is a little better than average, and they have the worst price to sales ratio. So to summarize, I have them trading at a 3% premium, and this company has been around over 100 years, so they're definitely not going anywhere. If you're looking for major growth, then you should probably avoid stocks like this that pay a nice dividend. But if you're looking for nice stable returns, then this is a good stock to own. I rank their free cash flows and revenue 6 out of 10. Their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.